Hello, this is Jared with the Helping Group at Loan Depot, and today I'm going to be lending some knowledge regarding should you pay points, no points, or should you get a credit for the interest rate you've chosen. And I get this question all the time. People say, hey, I want the lowest rate and I want to have the lowest cost. And it makes sense because no one says, hey, I want a crappy rate and I want to pay a lot for it. But it doesn't really work like that. They kind of go in opposite directions. So each rate associated has a points associated to it. So 1 point equals 1% of the loan. So if you're paying 1 point on a $300,000 loan, it's going to cost $3,000. If you're paying a half a point on a $300,000 loan, it's going to cost $1,500. So the important question should be, should you pay points, no points, or should you get a credit for the interest rate you've chosen? It's very individualized. It kind of depends on, like a lot of things on your loan, you need to put a little strategy into it. You need to think of your short and your long-term goals. So the way I explain it is like a teeter-totter, if that makes any sense. But a flat line is basically you have this interest rate with no points. And then if you decide to pay points, then your interest rate goes down. And if you decide to get a credit, your interest rate goes up, but your cost goes down. So maybe that would be kind of better explained. So, you probably know that interest rates change all the time, so it's never going to be exactly the same. But keep in mind if your interest rate changed by 1/8% on a $300,000 loan, it makes about a $20 difference in your payment. So if it costs you a quarter in interest rate to do that, a quarter in points to do that, that would be $750 on a $300,000 loan. It would take about 38 months to break even. So kind of depends, each interest rate is going to be a little bit different. Some days it might cost a quarter to go down in interest rate. Some days it might be 5/8. So again, on a $300,000 loan, that's between $750 and $1,875 difference. So it really depends on what the situation is. I think numbers are always better seen than heard. So what I do is put together a strategy for all the customers in Mortgage Coach, which kind of shows a side-by-side example and of all those loans. And it shows them both short-term, like when you close your loan, a mid-range, couple years out, and then over time, let's say 15 years or 10 years or whatever your goals would be. And I think that really kind of helps explain the benefits of it. So, a couple different examples of why you would do it. A lot of times the reasons why you would pay points is you're going to keep the home long-term, so it's going to be better over time. Maybe you need it because your debt-to-income ratio is high and you need to get your debt-to-income ratio and get it approved. And maybe you just want the lower payments overall. Some advantages of paying a higher rate and getting a credit for the loan is it reduces your upfront costs. You can use that cost to pay off other debts. If you plan on refinancing or selling your home within a short period of time, the break-even point is much sooner, which is important. And there's a lot of different things that make up the situation, so it's important to come up with a strategy and talk to your loan officer about that. So hopefully this helped clear some things up. Thank you for watching another video and lending some knowledge in the mortgage world. As always, you can always DM us, call or text at 541-870-8913, and I look forward to serving you in the future. Thank you.